Just because you're paying $3,000 a month in rent, meaning you'll get approved for the same amount when applying for a mortgage. Last week, a small business owner reached out to me. He's renting a downtown apartment for $3,000 a month, and he's pretty comfortable with that. His goal was to stop renting and buy a home. So once his lender finished the pre-approval analysis, he only qualified for $2,100 a month. Needless to say, he was a little frustrated and confused, and he asked me, hey, if I can afford to pay $3,000 a month in rent, why am I only qualified for $2,100 for a mortgage? So here's exactly what I told him. The first reason is that a mortgage is spread over a longer period of time, whereby a landlord is really concerned about 1 or 2 years, whereby a landlord or leasing agency are only concerned of your ability to pay for a year or two, but banks really relate to your ability to pay over a 25-year span. On the other hand, the landlord will only do a credit check your reference, and maybe look at your bank statements, opposed to a mortgage lender does a thorough review of your credit, and generally speaking, they want to see the last 2 years of your tax returns and employment history. But if you own your own business, like this gentleman did, if you're self-employed, be ready to provide tax returns, profit and loss statements, and a bunch of other documents that are not required by a landlord. Ultimately, it comes down to risk. Signing a lease is totally different compared to a bank. Lending a complete strangers hundreds of thousands of dollars, banks are always going to be more conservative than analyzing a risk, which is why banks are always going to be more conservative when analyzing the risk, which is why it's easier to qualify for a rent than it is to a mortgage. So if you like this content, please like, share, and subscribe for more.